Today, we are taking a deep fundamental look at Shell plc, ticker SHEL, and answering one important question. Can Shell stock reach $100, $110, or even $135 by 2027? At around $88.50 per ADR, Shell is not a high-growth technology company, but it offers something very different: strong cash generation, exposure to oil and natural gas, a major LNG business, dividends, and aggressive share buybacks. In this analysis, we will examine Shell's earnings growth, free cash flow, DCF valuation, dividend, balance sheet, bull case, base case, bear case, major risks, and finally my 2026 and 2027 price targets. Shell operates across several areas of the global energy market, including upstream oil and gas production, LNG, refining, chemicals, and other energy businesses. This diversification is one of Shell's biggest strengths because the company is not dependent on only one source of revenue. When crude oil prices weaken, LNG or trading can provide support, while strong commodity markets can significantly increase upstream cash flow. Shell's LNG business is particularly important because global demand for natural gas and LNG remains a major part of the world's energy system. Shell entered 2026 with strong operating momentum. In the second quarter of 2026, Shell reported approximately $9.8 billion in adjusted earnings and around $21.4 billion in cash flow from operations. These are extremely strong numbers for a company of Shell's size and demonstrate the company's ability to convert its global energy operations into substantial cash. However, investors should not assume that one exceptionally strong quarter will continue indefinitely. Shell's earnings remain highly sensitive to oil prices, LNG prices, refining margins, and global energy demand. Shell's earnings profile is best described as cyclical rather than consistently growing. The company generated approximately $17.8 billion of income attributable to shareholders in 2025, while 2026 has started with much stronger operating performance. Current market estimates suggest approximately $10.89 in EPS for 2026 and $8.94 for 2027, highlighting an important point. Earnings could normalize after an exceptionally strong period. Therefore, I would not value Shell based on peak 2026 earnings alone. Instead, I prefer to use normalized earnings and free cash flow when estimating its long-term fair value. Free cash flow is arguably the most important part of the Shell investment thesis. Shell generated approximately $42.9 billion of operating cash flow in 2025, with free cash flow around the mid-$20 billion range. The company has demonstrated that it can generate enough cash to fund capital expenditures while simultaneously paying dividends and repurchasing shares. This is important because Shell does not need massive revenue growth to create shareholder value. If the company maintains strong free cash flow and reduces its share count through buybacks, earnings and cash flow per share can continue increasing even when total company earnings are relatively flat. My illustrative DCF model uses normalized free cash flow rather than the exceptionally strong Q2 2026 result. I estimate normalized free cash flow in the low $30 billion range, a long-term growth rate of approximately 2%, and a discount rate around 8%. Under these conservative assumptions, a pure DCF can produce a value in the $70s per share. However, I would not rely on a traditional DCF alone for Shell, because oil and gas companies have extremely cyclical cash flows. A DCF based on low commodity prices can make the stock appear significantly more expensive than it actually is during a normal or strong energy cycle. Because of the limitations of a pure DCF, I prefer a blended valuation approach that combines normalized free cash flow, earnings power, shareholder distributions, buybacks, and an appropriate valuation multiple. Using this approach, I estimate Shell's fair value at approximately $100 to $105 per ADR. This suggests that the stock has reasonable upside from around $88.50, while investors also receive dividends and potentially benefit from continued share repurchases. The dividend is another major reason investors may be interested in Shell. Shell increased its dividend by approximately 4% at the beginning of 2026, and its quarterly dividend provides a yield of roughly 3.5% to 3.6% around the current share price. The important point is that Shell is not simply returning cash through dividends. The company also uses significant amounts of free cash flow for share buybacks. For a mature energy company, this combination of dividends and buybacks can create meaningful long-term total returns even without rapid earnings growth. Shell's aggressive share repurchase strategy is an important part of the valuation story. When the company generates excess cash and buys back its own shares, the number of shares outstanding declines. Assuming earnings remain relatively stable, that can increase earnings per share and cash flow per share over time. Shell has continued to return substantial amounts of capital to shareholders through both dividends and buybacks. And this is one of the reasons I believe the stock can generate attractive total returns even if oil prices remain relatively stable. Let's start with the bull case. If oil prices remain strong, LNG demand continues growing, global gas markets remain supportive, and refining margins stay healthy, Shell could maintain exceptionally strong free cash flow. At the same time, continued buybacks could increase earnings per share. Under this scenario, investors could also become willing to pay a higher valuation multiple for Shell. My bull case target is approximately $120 for 2026 and $135 for 2027. From an $88.50 starting point, the $135 target would represent roughly 53% price appreciation before considering dividends. My base case is more conservative. I assume oil and LNG prices remain reasonably supportive, but normalize from exceptionally strong levels. Refining margins become more normal, earnings decline somewhat from peak levels, and Shell continues generating strong free cash flow. I also assume that management continues dividends and buybacks while maintaining balance sheet discipline. Under these assumptions, I estimate a 2026 price target of approximately $100 and a 2027 target of $105 to $110. This is the scenario I currently consider the most realistic. The bear case is primarily driven by a major deterioration in the global energy cycle. If oil prices fall significantly, LNG prices weaken, refining margins collapse, and global energy demand slows, Shell's free cash flow could decline substantially. At the same time, investors could assign a lower valuation multiple to energy companies. This combination of lower earnings and lower valuation could put significant pressure on the stock. Under my bear scenario, I estimate approximately $75 for 2026 and $72 for 2027. This represents meaningful downside from the current price, although the dividend would provide some cushion. Shell's balance sheet is another positive factor. The company ended 2025 with approximately $45.7 billion of net debt and gearing around 20.7%, while net debt excluding leases was considerably lower. The important point is that Shell has demonstrated the ability to manage its balance sheet while continuing to invest in the business and return capital to shareholders. A disciplined balance sheet gives the company more flexibility during weaker commodity cycles. The biggest risk for SHEL is commodity prices. Shell can generate enormous amounts of cash when oil and gas prices are favorable, but the opposite is also true. A major decline in crude prices can reduce upstream profitability and free cash flow. Investors therefore need to understand that Shell's earnings are not comparable to those of a predictable consumer or software company. The stock's valuation can change significantly depending on where the energy cycle is heading. LNG is one of Shell's biggest strengths, but it also creates exposure to global natural gas markets. If LNG prices or trading margins weaken significantly, earnings could come under pressure. Refining is another cyclical business where margins can change rapidly depending on fuel demand, refinery capacity, inventories, and global economic conditions. Shell's diversification reduces some of this risk, but it does not eliminate it. Another long-term risk is the global transition toward lower carbon energy. Electrification, renewable energy, energy efficiency improvements, carbon regulation, and changing government policies could gradually reduce demand for some fossil fuel products. However, this is a long-term risk rather than necessarily an immediate threat to Shell's cash generation. Natural gas and LNG are likely to remain important in the global energy mix for many years, particularly as countries balance reliability, affordability, and emissions. At approximately $88.50, I see a relatively balanced but attractive risk-reward profile. The bear case is around $72 to $75. The base case is approximately $100 to $110, and the bull case reaches $120 to $135. That means the downside is meaningful, but the potential upside is larger if Shell maintains strong cash generation and commodity prices remain supportive. When the dividend and buybacks are included, the total return opportunity becomes more attractive than simply looking at the share price target. For 2026, my base case price target is $100. The bear case is approximately $75, while the bull case is approximately $120. I believe $100 is achievable if Shell maintains strong free cash flow, LNG remains healthy, and the market continues to value the company as a high-quality integrated energy producer rather than simply as a commodity producer. For 2027, my base case target is $105 to $110, while the bull case is approximately $135, and the bear case is approximately $72. My 2027 forecast assumes normalized earnings rather than peak cycle earnings. The key catalyst would be continued free cash flow generation, combined with share buybacks and dividend growth. If the energy cycle remains favorable, the upside could be considerably higher. So, what is my final rating on SHEL? At approximately $88.50, I give Shell a BUY rating, but I would classify it as a moderate BUY rather than an aggressive growth stock BUY. My thesis is based on strong free cash flow, a diversified energy business, major LNG exposure, a roughly 3.5% to 3.6% dividend yield, continued share buybacks, and a valuation that does not appear excessive relative to normalized cash generation. My final numbers are straightforward. For 2026, my base case target is $100, with a $75 bear case and $120 bull case. For 2027, my base case target is $105 to $110, with a $72 bear case and $135 bull case. My estimated blended fair value is approximately $100 to $105. The biggest variables to watch are oil prices, LNG prices, refining margins, free cash flow, and Shell capital return strategy. If those remain favorable, I believe SHEL can deliver attractive total returns through a combination of capital appreciation, dividends, and buybacks. Overall, Shell is not a stock I would buy because I expect explosive revenue growth. I would consider it because the company can generate substantial cash throughout the energy cycle and return a meaningful portion of that cash to shareholders. At around $88.50, I believe the valuation provides a reasonable entry point for investors who understand commodity cycle risk. My final rating is BUY, with a 2026 target of $100 and a 2027 target of $105 to $110, while the bull case could reach $135 if energy markets remain exceptionally strong.